Joining us right now is the Satori Fund founder and portfolio manager, Dan Niles. Dan, it's always a pleasure. We so appreciate your time this morning.
My pleasure, Maria.
I want to get your take on the Fed. I want to get your take on the macro story. But let's start with tech earnings. How would you assess the earnings period so far, Dan? And what are you expecting from Apple next week?
The earnings period so far, quite honestly, is better than what I would have expected, especially given what's going on with the macro picture with the failure of Silicon Valley Bank. But I think what you're seeing is the big are sort of getting bigger, and the companies more on the fringes, you're starting to see the economy take their toll. So, for example, you'll see Snapchat today, Pinterest today, looking a lot different than what you heard out of Google or Meta. And I think that's going to be a theme you're going to see throughout. And quite honestly, you are even starting to see some of that impact on the big giants like Amazon. One of the reasons that it's looking down today is because Amazon Web Services was growing 20% in the fourth quarter. That went to 16% in the March quarter. And now they're looking at it tracking at 11% in the month of April. And that's continuing to decline as the macro starts to impact them more. So I don't think we're close to done yet. I continue to believe things will decelerate as we go into a recession in the back half of the year.
Yeah, I want to talk about that because you have been so thoughtful about the macro story. I'll get to Apple in a second. I got to get your take on Apple because it's just a great window into so many things. But first, let's talk oil for a second. Chevron and ExxonMobil both reported this morning. They both beat first quarter earnings and revenue expectations. Oil prices this morning are actually, they remain at elevated levels. They're up about 1% on Brent at 79.20 and crude is at 74.97. That's up 0.25%. You've been watching these. You talked about the oil stocks and have owned them. Where are you on the oil trade, given that the Strategic Petroleum Reserve is down to the lowest levels in what? Since the 1980s, Dan?
Yes. So we have to look at commodities and we trade around them because unlike a stock like an Amazon, et cetera, oil prices can't go up infinitely, right? So when OPEC came out on April 3rd and did a surprise cut and oil prices spiked from 76 to ultimately 83, we sold on that day. And now, though, if you look at oil prices, they've come back down below those levels, down to about 75 on West Texas Intermediate. And so we're much more interested, and we put this out on our social media platform, that we were actually starting to buy back into the oil stocks. And don't forget, China, which is the world's second largest consumer of oil, they have Golden Week coming up, which is a week where everybody travels, they go to their hometowns. And I think what you're going to see is after 3 years of them being locked up due to COVID, you're going to see Chinese travelers really pick up. There was about 150 million that went and traveled abroad in 2019. That number was less than 10 million last year. So that's a big consumer of oil. We'll have to see what happens, but I anticipating buying more oil stocks going into that first week in May.
Yeah, I'm glad you mentioned Golden Week because this is one more idea that is part of your narrative. You're so thoughtful in terms of investing, looking at so many variables that could impact things. And I know that you've got a lot of this on danniles.com. So thanks for putting it all out there. Let me get your take on what you just said. You said Chinese citizens will be traveling, doing lots of services. You don't think they're going to go out and buy Apple iPhones, though, right? What's your take on Apple ahead of the quarter next week? What are we going to learn here, Dan?
Well, Mark Twain had a great quote. History doesn't often repeat itself, but it often does rhyme. And if you look at what happened in the U.S., when we got unlocked from COVID, we weren't out buying PCs or smartphones. And you saw Apple's revenues decelerate a huge amount from its peak levels of over 50%. You saw the same thing with PCs. And because people wanted to get out and travel, go to restaurants, go to movies, et cetera. The Chinese consumer has been locked up for 3 years. And so you're seeing that with a lot of the travel-related companies that have reported so far, where they're saying, yeah, we're seeing Chinese demand really start to pick up. The movie theaters, same thing. And so I think Chinese consumers, all they could do for the last 3 years is buy iPhones, buy PCs, go on the internet, play video games, et cetera. Now they're going to want to go out and do the same thing that the rest of the world has been doing for over a year now. So you look at Apple, and I always bring this up, you have to look at risk versus reward. And at a 27 PE, the market's trading at a 19 PE. So if there is some kind of issue with demand, because everybody's convinced themselves that this is a consumer staple, but it isn't. You don't need this the way you need water or food or things like that. People can cut back on Apple, upgrading their iPhone. They can't cut back on food or water. This is a very different type of company, but people want to believe that because it is the world's most valuable company. It has been going up, but at a 27 PE, you're not discounting any risk if there is an issue. And you've seen a lot of their suppliers having to cut numbers going forward. TSMC recently, Cirrus Logic, cutting numbers, and a lot of companies have talked about weakness in smartphones. So at this multiple, it's not something you want to be involved with, I think, because if there's a problem, you're going to get absolutely hammered.
And I know you think the next quarter we're going to see estimates come down for Apple. So there's that worry
I think March
as well.
Is fine. Yeah, I think March quarter is fine. There's not an issue there. I think it's when you look at June and the estimates people have, I think you're going to see June numbers come down. The stock, and don't forget, the results we've had so far from the big tech companies have in general been pretty solid. I mean, Google was down a little bit after their results. Amazon looks like it's going to be down today after their results. But in general, taken as a whole, they're better than what I would have thought. And so that's setting up a very high bar for Apple now, where people just assume, oh, everything's just fine. But, we'll have to see how they play out, especially, and I can't stress this enough, at that multiple, the risk to reward isn't in your favor. And so for me, we're going to be out, we're not going to be involved. We may be short a little bit, which is, I think, probably what happens, because that doesn't make sense. And you contrast that against, some other names like a Facebook. Yes, it's up a lot, but it's just above a market multiple. And so at least there you can say business is accelerating. Yes, the stock may have more than doubled off of its lows. We started buying it in the low 90s back last year. You had me on your program. But at least you're not paying an excessive multiple for the company, and growth looks really good. And that's a big difference.
It's a great point. And this is the issue that I keep bringing up to people who say, well, look, I want to buy tech. Well, I say, well, look at the market. They're up so much. And even in the face of expectations that we're going to go into a recession, that we're going to have an economy that slows down, this market, it will not quit. Let me get your take on what the heck happened in the month of March here, because I know that you believe the S&P 500 being up was largely due to the failure of Silicon Valley Bank and the Fed's reaction to it. The Fed is going to release that internal review of the supervision and the regulation of Silicon Valley Bank today, Dan. Meanwhile, U.S. officials are reportedly coordinating urgent talks to rescue First Republic Bank. Sources say the government's involvement is helping to bring banks and private equity firms to the table to perhaps buy some of these assets. What do you think is behind the rally in stocks, even in the face of this crisis in banking and worries over the macro story, Dan?
Well, I think it's pretty simple when you look at it from this perspective. If I told you, Maria, hey, we're going to get a global pandemic. We're going to get a global pandemic that shuts down the world. Your first thought isn't going to be, let's go run out. Your first thought isn't going to be run out and buy stocks. But that's what happened in 2020. The S&P was up about 16% because the Fed expanded their balance sheet by about $3.2 billion. Now, what you saw during Silicon Valley Bank failure is that the balance sheet expanded by about $400 billion. And that's why in the month of March, with the second and third largest bank failures in history, the market went up. Now what you've seen is over the last 5 weeks that balance sheet has started to shrink again. It's gone down about $170 billion. And so I think the risk is coming back into the market where you're going to have to look at earnings again. Because inflation is still high. Yes, it's come down from peak levels of over 9% to 5%, but it's still well above the 2% that's the Fed target. And so I think you're going to see the Fed raise next week by 25 basis points. They're going to go on pause. But I don't see a rate cut by the end of the year, or 2 rate cuts, which is what the market is discounting, because I think inflation is going to remain higher than people think because of China and their reopening, keeping commodity prices high, and the fact that we have 70% more jobs than people unemployed, which will keep wages high.
Dan, it's pretty unbelievable that here we're expecting the Federal Reserve to be cutting its balance sheet, right? They're talking all about the unwind, as well as the higher interest rates. But what you're saying is that, in fact, the Federal Reserve has been expanding the balance sheet by almost $400 billion just in 3 weeks, reversing the balance sheet shrinkage.
Yeah, and that's what happened. They basically undid 5 months worth of shrinking the balance sheet in 3 weeks. That's why the market was up.
Wow.
Same reason the market was up in 2020 in the middle of a global pandemic when they expanded the balance sheet by 3.2 trillion. Now they're shrinking it again, and so you're going to have to go back and look at the fundamentals of these companies. And good earnings will be bought. High multiple stocks are much more risky, and that's what you're going to have to deal with. And so, between now and year end, our view is that the market will go down because you're going to go into a recession because inflation stays high.
Really fascinating stuff. Dan, thanks for getting up early for us to give our viewers a leg up on your phenomenal information. We'll go to danniles.com for more. Good to see you, sir.